that the market was always in long. What you can do is just go ahead and buy at the money calls, right? You could also, we got a test of the moving average. The market's still always in long. You could buy calls here. We have a double bottom bull flag and a triangle. Looks like the market's going higher. You can buy calls here. So you had several reasons and several opportunities to buy the at the money 43 calls. Once the market gets here with a wedge top and the higher high, major trend reversal, you take your profits as the market's turning down right here. And this is the chart of the 43 calls. Again, for that Las Vegas Sands 5-minute chart that I just showed. So you buy your calls here, or you could buy your calls here, or you could buy your calls here. If you bought them here at the worst price at the top of the spike, you paid 66 cents. If you bought on the 5-minute bar that broke out on the 5-minute chart here or here, you paid about 70 cents, 72 cents. And if you exited up here, you would have had about 30 cents profit, which is $30. Here's an example with Baidu. Okay, if you just happen to look at Baidu and it's doing this, it's always in short. The odds are it's going to go lower. So you can just go ahead and buy at the money puts, right? Possible final flag, a little too short. And then we have consecutive sell climaxes and then a huge sell climax here, right? You could look at that and say, that's probably the end of the move or close to the end of the move. I'm going to go ahead and sell out of my puts, which you could do here. We had a two-legged lower low after consecutive huge sell climaxes, so we're probably going higher, especially with this bull inside bar for a signal bar. You could buy Baidu here, or you could just go ahead and buy an at the money call. All right, and it turns out it went into a huge trend into the close. You'd probably exit below this two-legged this two-bar reversal. So this is the chart of the puts. The last chart was of Baidu, which was in the big bear trend. If you bought where I showed you on that chart, where the market was clearly always in short, you would have been filled somewhere around here for $1.05. You would have paid $1.05 for your puts for the weekly at the money 115 puts, and you would have exited here, and you would have received $3.50 for your puts and made a profit of $245. Okay, if you bought the calls at that bottom, at the sell climax, you would have bought the calls for $2.55, and you would have exited them for $5 at $5.30, and a profit of 280, which is $280. And that is the end of my module on trading options, weekly options for day trades. And there, you just go ahead and buy an at the money 665 put. Okay, Apple continues down, 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 and now we're in a very tight wedge, and we got a strong bull reversal bar. As soon as the market breaks above that bull reversal bar and out of the channel, you exit your put. You exit your put, and you think about buying calls if you're really aggressive. Here, 2 bars later, the market's always in long. We have a small high 2 bull flag, and a possible failure from the breakout of that flag. I think it's reasonable to exit the puts. We should get 2 legs up from the wedge bottom. This is the end of the first leg up, so we should pull back and have a second leg up. I would exit the calls, and if I was trading the calls aggressively, I would buy here a wedge bull flag, 1 push down, 2, 3, 4, or bear spike, 1, 2, 3, and a failed bear breakout. So I would exit the calls here and possibly buy them again here for a test of the high. That's aggressively trading the puts and calls. I make all the decisions based on the underlying chart. This is the 5-minute chart of Apple itself, but I go ahead and I trade market orders on the options. So instead of selling Apple here and buying Apple here and buying Apple again here, I just go ahead and trade the options. Okay, here's a chart of that same day in Apple, and this is a chart of the puts. Okay, so if you bought the puts down here when Apple was becoming always in short, the puts greatly increased in value as Apple continued to fall, and you could have exited the puts here. If you buy them for $6.50, and you sold them for $15.80, you would have had a profit of $9.30, which is $930. If you bought the puts again here, you could have exited them there for a profit of $2.90, which is $290. You multiply times 100. Some stocks have very good volume themselves, but their options often don't trade very actively. So some stocks have small volume, and in general it's better not to day trade options if the volume is small, because the bid-ask spread is huge, and you don't want to pay 30 cents on the spread in and then 30 cents on the spread out, because it's very difficult to make much of a profit. Also, it's very difficult to get out at the price you want if the options are not trading actively. If nobody's trading the options, and let's say you have a profit and you want to sell out of your put or sell out of your call, if nobody's willing to take the other side of your trade, you usually have to offer a worse and worse price, and all of your profit can disappear as you attempt to get out. Okay, all stocks with options having small volumes sometimes have very active days. So sometimes a stock where the options trade very little at all can have days where the options trade extremely actively, and when that's the case, you can day trade them. Here's an example of Las Vegas Sands. Okay, the market was in a bear channel. We had a double bottom major trend reversal here, and then a higher low major trend reversal and a 2-bar reversal. And let's say you noticed somewhere around here this huge bull spike, and you decide very tight spreads, and usually you can trade at the market. With the Apple and with stocks, I generally enter and exit with limit orders. Although Apple, when you have 20,000 contracts per strike, you can trade market orders. And the tight bid-ask spread, 10 cents, you get really good fills. Which stocks to use? Any stock or ETF where the volume of the options is 1,000 or more. So if the average strike price, the average at the money call today or put is trading 1,000 contracts, you certainly can day trade that weekly put or call. If it trades 5,000 contracts, if the at the money put and call have each about 5,000 contracts, that's extremely good, and those are extremely good options for day trading. Okay, you want a daily range of at least 50 cents in the underlying, right? Excuse me, in the option. Ideally, you want the put or call to move up or down about 50 cents during the day, and that means the stock should have about a 1% daily range. The bigger the better. The more the stock moves, the more the option will move. And how do you find what stocks to trade options today? After the first 30 minutes or so, you can scan your stocks for stocks that have very big bull or bear spikes, and you can use a quote page and sort. You can sort based on the average daily range, the percentage daily range, what percent the range is of the underlying price, and you just look for the stocks that have the biggest range. In 2012, stocks that usually are good on most days: the Spider, Apple, Amazon, Google, Goldman Sachs, IBM, GLD, they're good on most days. Just about any stock can be good on any day if there's some special situation, a news event, for example. This is a chart that I use for scanning. I have it sorted right now based on the range. On this particular day, at the time that I scanned this, Google's range was $20, which is huge. Price line, $19. I could also sort based upon how big today's range is compared to the range of the stock. So let's say, so this $20 move in Google is 20% of the total range of the stock. I can also sort on the basis of the percent change today. So what percentage change is Google on the day? Is it up 1%? Is it down 1%? And then I take a look at the chart, the 5-minute chart, to see what's going on. So Panera, for example, had 5 consecutive huge bear bars. So that would be a reasonable stock to just go ahead and buy an at-the-money put at the market. And then the stock pattern, little wedge bottom, get out at the market down here. All right, here's Apple on a recent day. There was a strong bear breakout on the open, right? We gapped up, strong bull bar, and then 4 bear bars, and we tried to push up again, and again. So we have a small wedge bear flag, and then a strong bear breakout and follow through, okay? So at this point, the market's always in short, probably going lower. So you can just go ahead. Right now, the market's around 665, 670, somewhere in this market to be turning down, having a pretty substantial pullback after such an extreme buy climax. We have a reversal bar closed below the middle of the bar, but a bull body instead of a bear body, so that's a little bit less certain. But at the money is 148. You have a choice. You could short this, but you risk that the market may have another couple of very big pushes up, and you could be quickly down much further than you'd want to be. The alternative is to buy an at-the-money put, a 148 put. And you could either exit if the spider goes above this top, or you could scale in and buy more puts higher, betting that the market will at least come down to your original entry price. All right. You could then decide what your target is. You want 10 bars, 2 legs down. Well, you have 1 leg down, pull back, and a 2nd leg down, and you could exit your puts down here. Here's a chart of that particular at-the-money 148 put, right? So you bought the put here, 33 cents above this signal bar. You wouldn't be placing a stop order. You'd simply buy at the market, or you'd place a limit order, a tick or two above the most recent price. And then you would exit here, which is corresponding to over here, okay? You'd exit your puts at 95 cents, and you'd have a 62-cent profit. So you bought your puts here at this signal bar, or as soon as the market turned below, and you sold out of your puts as soon as the market turned above this bull reversal bar at the bottom of that high 2 bull flag. Okay, the risk was small and the reward was big. If you took profits at the end of that 2nd leg down, you made 62 cents on your initial risk of 33 cents. Even if the even if the put fell to 0, right, the most you could have lost is 33 cents. Okay, 62 cents profit corresponds to $62 because each put controls 100 shares of the underlying. Even if the spider continued up for another $1, the put might only fall 10 cents, right? So instead of being 33 cents, it'll fall to maybe 20 cents. So even if the spider went up $1, which is a lot, the value of your put would not fall all that much. So you really don't have much risk. Okay, even if the spider continued up another $1, if you thought that your premise was still valid, that a big correction after the consecutive buy climaxes was likely, you could add on. Let's say the spider went up $1 and the value of your put fell to 20 cents. You could buy more puts, maybe even twice the size of your original entry, with the goal of getting out if the spider came back down to that original signal bar low. Okay. Anyway, if you do add on, especially if you double up, and especially if you feel that your premise is still valid, you'll probably get out with at least a small profit, and possibly a big one if the market turns strongly down in your direction. Okay, put versus stock. Okay, if you bought the weekly at the money put, okay, your actual risk was only 3 cents, and the put only went against only went 3 cents against your original entry price. Your profit on the put, 29 cents, or times 100 shares, $29. So it's about 10 times your actual risk. And you could have scaled in if the S&P moved higher and the put fell in value. Instead, if you traded the spider, the market quickly went your way, and the actual risk was only 7 cents. The profit, had you traded the spider instead of the put, 81 cents, or about 11 times your risk, comparable to what you had with the put itself. However, you'd be less inclined to scale in if the spider kept racing up another $1 or so, not in a strong bull, whereas you could do that with the spider and without much worry. Okay, if you bought the weekly put, maximum risk 33 cents, actual risk was only 3 cents, and much less stress. If you bought the spider, your actual risk, your maximum risk realistically was $200 to $300. You know, if the spider raced up another $2, $3, you could easily lose $200 to $300 if the market went into some kind of blow off top. Whereas the most you could lose with the put is 33 cents, which is $33. These 148 puts traded 48,000 contracts today. Huge volume, very tight spreads. Again, very popular with day traders. Okay, some stocks are great for the weekly options. Most stocks have a range of about 1% or more. And the weekly at the money options have about a range half that much. So if it's a $100 stock, the range on the stock will be about $1, and the range on the put and the call, the at the money weekly put and call, will be about 50 cents, and that's plenty of room to make 10 to 20 cents profit. Okay, let's take an example. A $100 stock moves $1 when the range is 1%. So if the average daily range is 1%, that's a $1 move, 1% of $100. The put and call would move about half that much, 50 cents. So that's plenty of room for profit. Apple, on the other hand, it's a $600 stock right now. A 1% range is $6. So Apple, on an average day, moves at least 1%. So the range of Apple is at least $6. And that means the average range of a put or call might be about $3, and the at the money weekly put or call in Apple might cost $6, and the average range would be $3. The bid-ask spread on those weekly calls might be only 10 cents, which is extremely good on a $600 stock. So very tight spread, very big range. Volume lately in Apple on the weekly options, it's often 20,000 contracts per spread. So usually itself, it's possible if your data went down or if the broker had problems, the spider could fall $2 or $3 more before the problem was fixed, and you could easily lose $200 to $300. Theoretically, you could lose the full $145, which is $14,500. You know, that's not going to happen, but you certainly could lose hundreds of dollars. Those 145 calls today traded 120,000 contracts, so huge volume, and the spreads are extremely tight. And because of that volume and the tight spreads and the ability to use market orders, and because of all the other advantages that I mentioned, day trading, spider weekly options is extremely popular with traders, especially during unusual days where the range is exceptionally large. Let's say you want to fade a climax, right? Let's say the market has a series of climaxes, sell climaxes or buy climaxes, right? And you feel like it's about to reverse. You're not sure if you're picking the actual extreme, but you feel pretty confident that it'll happen pretty soon, right? After a series of climaxes, the market will usually have a big reversal, at least 10 bars, 2 legs, TBTL. And sometimes the risk is too big to scale in against the trend. If the market's falling in huge steps down, if you buy, it could have another step or two down that are huge, and the risk could be much greater than you would care to assume. An alternative is to buy weekly options. So here's an example. A huge bull breakout on the FOMC report, a series of buy climaxes. Each trend bar is a climax, each series of trend bars is a climax. So here, these 2 bars, these 4 bars, that's a climax. Another 3, 4, here. All right. So we've had a series of extreme buy climaxes. We're in an area of a measured move based on the height of this initial spike. We had a pause and then a resumption. All right. So we're in the area of a measured move. You can argue this is a very steep wedge top. 3 pushes up, 1, 2, 3. Possible final flag. So there are lots of reasons for this will never happen again. And the data provider will say the same thing. Invariably, it happens again. All right. So huge volume days can create problems with your broker and with your data. And that's not even considering the problems that you can have with your internet provider. Okay, so stuff happens and your data can be interrupted, your software can lock up, your broker software can lock up, and you can be stuck in a trade, or you can be stuck not knowing whether you're still in a trade, whether your stop has been hit, and it's very, very upsetting. And I say that from experience. It's happened many times to me over the years, even though the brokers and the data providers swear that we'll fix it right away and it'll never happen again. Let's take an example. Let's say the signal bar in the spider is 5 times bigger than an average bar. Okay, if you normally trade the spider and use a 20 tick stop, okay, but now the current bar is $1.15 tall, right? That means your risk here is $1.17, 1 tick above, 1 tick above. Okay, so your risk is more than 5 times normal. It's about 6 times normal. So if you're going to trade, you have to trade 1/6 your normal size, and the movement may not be enough after that one big bar to make much of a profit. As an alternative, you may just go ahead and buy the at-the-money call. Okay, the call is based on the underlying on the spider, and so go ahead and just buy a call on the close of that strong breakout bar, and only exit the call if the spider falls below the low of that signal bar. Yes, that's far below, 117 cents below your entry price, or your theoretical entry price. But that's okay. You do not exit the call if the call falls below the low of that bar, right? So you're basing your trading decisions not on the chart of the call. You're basing your decisions on the chart of the underlying, in this case the spider. Okay, so here's an example. There was an FOMC report here, and we had a huge bar on the spider. This is the spider on the left. This is the weekly call, the at-the-money call on the right. The call expires tomorrow. Okay, the spider had a huge bar and then a huge pullback on the very next bar. Right? If you buy the close of this bar, your stop is below the bar and 75 cents below, and that's more than 3 times the usual 20-cent stop that you might use. Your alternative is to trade the weekly calls. So if you bought a call when the spider is here and you held through the 3 pushes up, the 2-bar reversal, you exited over here. Okay, so you bought the call when the spider does this, you exit the call when the spider does this. Okay, here's the chart of the spider, the call. So you bought the call here and you exit here, right? So you bought the call here at 71 cents and you exit here for $1.75. So you made 74 cents on the trade. Okay, this is why you do not exit the call based upon the call chart. The charts are much less reliable. You can see the call dipped well below the signal bar, whereas the spider itself never dropped below the signal bar. So you ignore the chart of the call. You only look at the chart of the spider, and you make your decisions based on the spider, the underlying. Okay, call versus stock. Here, the stock is an ETF, so it's not really a stock. So if you bought the weekly at-the-money call, your actual risk was 31 cents. That's below the bottom of that dip. The profit on the call was $1.04, which is about 3 times your risk. If you traded the spider itself, your actual risk was 52 cents, okay, to the bottom of the bar after you entered. And your profit was $1.61, about 3 times your risk. $1.61, about 3 times 52 cents. The call, the profit was about 3 times your actual risk. But you had potential problems with the spider that you did not have with the call. If you had problems with your data or your broker, your risk could have been much, much worse. Whereas with your call, you can only lose the cost of the call itself. So there's a guaranteed floor below the market that's not very far away. For the spider, it could go to 0 and you can lose a lot of money. So there are some benefits to buying the call. The maximum risk, no matter what problems happened that were beyond your control. If you bought the call for 71 cents, you paid $71 for it. The maximum that you could lose is $71. If you bought the spider, the puts, well, we had a series of consecutive sell climaxes. We broke below the trend channel line, and we're trying to reverse up. We have a 1-bar final flag, a bull reversal bar. We have a spike, a bear spike, with 3 pushes down, and we're getting near the end of the day. To me, this would be a good location to exit. So when the spider turns above this bar, it's at 141.65, right? $1 less than where you bought it, right? I would get out of the puts at the market, for example, or with a limit order, maybe a penny or two above the last trade, the current price. Okay, what took place on those 143 puts? This is the chart of the puts, right? This is the bar where the spider became always in short, and you bought the puts here. The ask was at 85 cents, so you bought them at 85 cents. Okay, you exit the puts here at the end of the day as the spider was turning up. You can see the puts are turning down. The bid at the puts is 150, right? So you'd be able to sell your puts at 150. So you bought them at 85 cents. You sold them at 150. Okay. The profit is 65 cents per contract, but it's for 100 shares of stock, so it's $65. So you made $65 on your one put. When the bars are huge, the risk is very, very big. Position size sometimes has to be very small. Let's say you're trading the spider and you have a huge bar. You might have to reduce your position size to 1/5 normal, right? 20% of normal. And the profit that you stand to gain sometimes just doesn't feel worth it when you're trading that small. If the market moves huge after that big bar, you can make a lot of profit. But sometimes you're afraid the market may be settling into a trading range, yet your stop has to be far away. One alternative that you can use is options. Another situation that happens all the time, you can have problems with the broker. The broker's software or order system may go down. You may have problems with your data. I have had problems with many brokers over the years, and they don't compensate you for problems with their software and their systems, right? It's user beware. Any problem, you assume the risk and you take the loss. And I've had problems with the data, and I'd call and yell at the data people, and they'd say, "Oh, it's just an exceptional problem. It's never going to happen again." And then a year later, it happens again. The same with the broker. There are days that come every few years that are so huge and so fast that they overwhelm your broker, and they overwhelm your data provider, and broker will say, "Oh, well, we're going to make changes in % bid-ask spread in the Baidu 100 calls. So now you'll get filled at the bid, which is 190. So your 280 stop got filled at 190, 90 cents worse than you thought it should be filled. Okay, that's why you cannot use stops when you trade options, or why you should not use stops. What you do instead is you look at the underlying. You look at the chart of Baidu, the stock itself, and if it looks like the premise is no longer valid, okay, if it looks like your premise, your thought that the market was going up is wrong, you get out. So you quickly go to Baidu and you get out with a limit order at the best price you can, which usually means at the bid. Don't be greedy. You know, you're wrong. Just accept it. You're going to be wrong a lot in trading, and when you're wrong, just accept it. Get out and look for the next trade. Take your loss. Don't get greedy and try to minimize your loss, hoping that the market will go your way a little bit so you can get out with a better, with a smaller loss. When you're wrong, just get out. Okay. So once you decide that you're wrong and that your underlying premise is no longer working, place a limit order that gets you out within seconds. You can exit at the bid without, or even a little bit worse. Just get out. Don't try to save a couple ticks. Just get out when you're wrong. Okay. When do you enter? As soon as the always in position of the stock is clear. Right? If it's clearly going up, it's always in long, buy a call. If it's clearly always in short, if it's clearly falling, buy a put. When do you exit your option? When you use the price of the stock and the chart of your stock as your guide. You swing your call or your put until the always in direction reverses, and you exit with a loss when a stop on the underlying would be hit. So let's say you're long the spider and it's going up and up and up and up and up and up, and then you decide, oh, maybe it's entering a trading range. I'm going to put a stop below this bar. The market falls below that bar. Go to your options and get out at the market, or place a limit order below the most recent price and get out. Okay. When do you take partial profits? Well, when the underlying, let's say the spider, reaches twice the initial risk, that's when you should be thinking about taking some partial profits in your calls, assuming you bought a call. Let's take an example using the spider. Let's say the spider is at $140, and let's say that tells you that a cost of 100 shares is 100 times that, $14,000. So you could buy 100 shares of the spider for $14,000. The cost of one at-the-money weekly call or put might be about 70 cents times 100 shares. That's $70. That is your maximum loss, even in a stock market crash. The most you can lose is $70. If the spider goes to zero and you bought the spider, you can lose $14,000. All right, so let's say the spider rallies $1. Let's say it rallies 1% today. Okay, if you bought the spider at 140, your profit is $140 if you bought 100 shares. Okay, your profit might be $50 if you bought one call. If the spider fell 2% today, the loss is $280 if you bought the spider, but you maybe only will lose $50 if you bought the call. If the spider fell 5% today, a big move in the spider, you would lose $700 on your 100 shares. However, you maybe only will lose $65 if you bought the call, right? So on the downside, the losses are much, much smaller. Even though the rate of loss might be very fast in the spider, the rate of loss in the call will be less. Okay, the spider became, here's another example. Over here, the spider had a very strong breakout, a wedge top, very strong breakout, follow through a bar, and that probably confirms the always in short. So we have a wedge top, a bear breakout below the moving average, and a follow through bar. Most traders would say, yeah, it's going to go short. Okay, it's a short. Okay, the spider is at 142.65 at this moment, right? If you wanted to trade options instead of the spider itself, you could buy puts, right? And when would you exit? If the stock goes against me greatly during the day, usually the option will not fall to zero. It may lose 20 cents or 30 cents, but will not fall to zero. So, worst case realistically is I'm risking 20 cents or 30 cents. And if I had a stop in the spider, I might have a stop 20 or 30 cents away. So there's no real sense and no need to have a stop. Okay, as the price of the stock changes, the price of the option changes, and all option prices change even if no option trades take place. Okay, so let's say the spider's at 140 and it goes to 145. Well, guess what's going to happen to the call, the at-the-money call? If the spider goes up 50 cents, the call will go up 25 cents. In general, an at-the-money put or call moves about half as much as the underlying. I'm not going to go into all the Greeks and the explanations why that's not exactly the case, and it's not exactly the case, but it's in the ballpark. Okay, so let's say I buy a 140 call when the spider's at 140, and I'm planning on getting out if the option falls 10 cents. I can place a stop order to get me out 10 cents below, right? However, the spider could fall to 139, and if no trades took place in my 140 call, let's say all the other calls were trading and no trades took place in my call, the bid and ask could be well below my stop price, but I'd still be holding my call. My stop would not be triggered, because a stop only gets triggered if a trade takes place in your particular market. So if I'm holding a 140 call and nobody is trading the calls, my strike price, the bid-ask spread can continue to fall as the spider falls, but my stop won't get triggered. That's usually not a problem in the spider because the volume is so big and the options are traded so actively. But if you trade Goldman Sachs or let's say Baidu or some thinner stock, that can be a problem. You can still trade them, but you cannot put stops in the options market unless you're willing to take huge slippage, and the slippage can be very, very big. Okay. Remember, if the stock falls $1, right, the value of your call will fall 50 cents. And if you look at the bid-ask spread, you'll see that the bid-ask spread is 50 cents below the price that you paid. However, unless a trade takes place in your particular call, the stop won't get triggered. Let me give you an example. Let's say Baidu is at 100, and you buy the at-the-money call, the 100 call, and you pay $3 for it. And you say, well, I don't want to lose more than 20 cents. I'm going to put a stop to exit at 280. So if my call falls to 280, I'm going to get out and take a 20-cent loss. There's a problem with that. Let's say Baidu starts to sell off and it falls down to 99, right? That means the value of your call is probably now worth about 250. And if you look over at your positions, you might find you're still holding that 100 call and it's now worth 250, right? How could it fall to 250, well below your 280 stop, and your stop not get filled? Well, it's because the Baidu options are not actively traded, and it's possible that no trades took place in the Baidu calls, even though Baidu fell $1 and the value of the call fell 250. Your stop at 280 only gets hit if there's a trade that takes place in that call at 280 or below. So right now you're looking and you're saying, Baidu's at 99, my call is at 250, and I'm still long, and the market's falling. What am I going to do? Okay, if someone finally places a trade in that call at 210, if someone buys the call, sells the call at 210, right? Remember, you bought it at 3, and it's way below your 280 stop. Okay, so somebody finally buys a call or sells a call, and the trade takes place at 210, right? Okay, this is the first trade that took place, at or below your stop price. So now your 280 stop becomes a market order, right? You'll get filled at the bid, but the bid might be 190, right? There might be a 20 trading an option that has good volume. In general, you can trade weekly options on expiration day. The volume is usually so huge, and the movement is good, and the time decay usually doesn't come in until the very end of the day. So for most of the day, you can trade the weekly options right up until the final hour or two. An active market like the Spider, SPY, you certainly can trade the weekly options even though they expire today on a Friday. Okay, let's compare this Friday's option with next Friday's option. So an at-the-money call in the Spider, okay, and an at-the-money call in the Spider. And this is right through the end of the day, okay? This is today's option expiring today. The range of that call was 78 cents, okay? And it closed up here 70 cents. If I traded next Friday's option, the range was 70 cents, a little bit smaller, right? But look at the volume, 42,000, which is great. But look at today's volume, okay, on the option trading today. 166,000 contracts today. Tremendous volume. You can trade it at the market. You don't have to worry about limit orders getting in, getting out. You can just trade it. You trade it at the market, and you have very good range. And the market traded well right up to the final minute of the day. 42,000 contracts. You can also trade at the market. To me, I would trade this: bigger volume and slightly bigger range. So use the chart of the stock to make your trading decisions. I don't look at the chart of the options when I'm deciding, should I buy or should I sell. To me, the options are a reflection of what's going on with the underlying stock. And I place my entry orders in the options market, and I can exit with limit or market orders, but I'm making my decisions based upon what the underlying stock is doing. So for example, if the Spider looks like it's a buy and I'd rather buy options, I immediately buy at the market or with a limit order at the money call, assuming that I'm trading the options today instead of the Spider, which I sometimes do. Sometimes I'll take swing trades in the Spider calls or Spider puts, day trades, swing trades, holding for an hour or two or three. And I'll take scalps in the E-mini, the futures contract. And what kind of protective stops do I use with my options? None. The worst case is the option falls to zero. That is my stop. If I buy an option for 60 cents and the stock market crashes, okay, the most I lose is 60 cents. So that is my stop. My stop is zero, is the cost of the option. At the money to me is the approximate nearest strike price to the underlying. I prefer slightly in the money to out of the money because the in the money option will have a broader range than the out of the money option, and that gives me more opportunity for profit. When you can't decide in the money or out of the money, it doesn't matter. Just choose either. An example: let's say a stock is at somewhere in the range between 99.80 and 100.70. Okay, I would trade the 100 puts. The 100 calls. So even 99.80, the 100 calls would be slightly out of the money, but only slightly. So I would, at 100.70, the calls are way in the money, but I would still probably trade the 100 calls instead of the 101s. If it's at 99.40, I would trade the 100 puts, even though that's way in the money. But I'd rather do that than trade the 99s, which is out of the money. Here's an example comparing out of the money and at the money calls. On the left, here's the Spider, and it's a line chart, not a bar chart. And this is what took place today. We had a 90-cent range. Okay, the market opened up. At the money was 141 earlier in the day. That's the closest strike, right? So at the money is 141. Had I bought an at the money call at the absolute low tick, well, let me put it this way: the 141 call had a range of 59 cents today. The spider itself had a range of 90 cents. But if I instead bought the out of the money call, the next strike up, the 142, it's a lot cheaper, right? It's 20 cents instead of 60 cents to buy it, but the range was only 32 cents. And if your commissions are a penny in and a penny out, and the spread is a penny in and a penny out, that means your overhead is 4 cents. And when your range is 32 cents and you have 4 cents built-in overhead, it's very hard to make much of a profit, because you're not going to be buying the low tick, you're not going to be selling the high tick. You'll be buying somewhere in here, 30 cents, and you'll be selling here, 40 cents, and then you have 4 cents overhead. So you're making 6 cents profit on a win, and you're losing 14 cents on a loss. And it's impossible to make a living when your losses are 2 times or more greater than your wins. On the other hand, if you have a 60-cent range, 59-cent range, it's much easier to make a profit. You buy down here around 70, you sell up here for around $1, and you can make 30 cents on a good move. Okay, what happens on Friday? Weekly options, they expire every Friday. What about trading them on a Friday? Should I be trading next week or the monthly option, which might expire 2, 3, 4 weeks out? If in doubt, always trade the next week or the next month to make sure that you're... This is Al Brooks, and this is my price action trading course. This module is about trading options for day trades. Why trade options as day trades instead of trading the underlying? Well, first of all, the absolute risk is much smaller, yet the cost and profit are about the same, and it gives you peace of mind. The less you have to worry about money, the more objective you are about your decisions, especially when the market is in unusual circumstances, moving very, very fast, as it does several times a year. The bid-ask spread and the commissions are too big for scalping in general, so it forces you to swing trade. It also forces you only to take very strong trades, and these strong trades are the most profitable. Here's the 5-minute E-mini chart, and let's say for whatever reason you did not get long earlier and you decide to get long up here. You know that your stop is below the bottom of the bull spike, and you say, well, wow, that's 8 points away. I can't risk 8 points, and yet I only trade one E-mini contract, so I can't take the trade. Well, an alternative to doing that is to use options as an alternative. You could simply go ahead and buy an at-the-money weekly spider call, or if it's still too expensive, buy a slightly out-of-the-money spider call. Options are a very good alternative to stocks, and especially a big market like the E-mini or the spider. Spider calls have tremendous volume, and they're excellent alternatives to taking outright positions in the spider or the E-mini. Let's give it an alternate example here. Let's say you happen to buy here, and you're still long here, and your stop is now, 7 points away, and you don't want to risk that much. Yet you think the market is still going a lot higher. You should be reducing your position size to keep the risk the same. But if it's too far away and you can't reduce your position size, instead of continuing to hold your E-mini and using a stop that might be too tight, like maybe below this bar, what you could do is simply sell out of your E-mini position and go ahead and buy a spider call, an at-the-money spider call, a weekly call. And that would be a very good alternative. Let's say you bought it and it cost 80 cents. Let's say you bought a weekly call. The most you can lose is 80 cents, which times 100 shares is $80. So the most you can risk is, the most you can lose is $80. And if the market goes up for a measured move based on the height of this spike, you probably will make $80 by the end of the day. I usually use weekly options. They expire on Friday's close, and there's very little time value to them, and they also cost a lot less than monthly options, because they're expiring within 1 to 5 days, there's very little time value in the premium. The volume of the at-the-money put or call can be huge, and that creates very small bid-ask spreads, especially on markets where the options are very active. For example, the spider. And you can, when that's the case, you can use market orders. I would not use market orders on a stock where the spread is very big, like Google. But a lot of times with Apple, you can do it, and always with the spider. Some abbreviations: ATM, at the money; OTM, out of the money; ITM, in the money; AIL, always in long, a clear bull trend; AIS, always in short, a clear bear trend. I'm not going to be talking a lot about option basics, so I'm assuming that traders paying attention to this module know the difference between an at-the-money call and an out-of-the-money call. If the spider is at 140 and you buy the 140 call, you're buying at the money. If you buy the 145 call, you're buying an out-of-the-money call. If the spider is 140 and you buy a 130 call, you're buying a deeply in-the-money call. If it's at 140 and you're buying a 135 put, you're buying an out-of-the-money put. Okay, what exactly is at the money, ATM? The stock is rarely exactly at the option strike price. For example, let's say the stock is 140.25. There is no strike at that price. There's a 140, there's a 140.50, there's a 140, a 141, but no 140. One nice thing about the spider is a lot of times they'll have strikes that are 50 cents apart. So on the weekly options, a lot of times they'll have a 140.50 call or put. So if the spider's at 140.40, you're not forced to buy the 140 call or the 141 put. You can buy the 140.50. Okay, so